Hello and welcome to this week's edition of the Echo45 Advisors Market and Economic Update. In this video, we'll discuss the recent market pullback and what's driving investors' concerns. Specifically, the market fell 2.5% during the first 2 weeks of the second quarter after beginning the year with a historically strong return. This was primarily due to changing expectations around inflation and the Fed, as well as escalating geopolitical tensions in the Middle East. Over the next few minutes, we'll discuss all of these topics and explain how investors can keep them in perspective. First, the recent attack by Iran on Israel resulted in a short-term market decline as investors worried about worsening tensions in the Middle East. While the situation is still unfolding, the initial attack of hundreds of drones and missiles launched from Iran resulted in minimal damage. Israel and its allies, including the United States, were given ample time to deploy countermeasures. At this point, many hope that both nations will show restraint and prevent an all-out conflict. Without diminishing the severity of the regional conflicts, the loss of life, or the destruction that has been caused over the past few years, many investors may wonder how these conflicts impact the global economy and their portfolios. History shows that while there can be short-term market swings when these events occur, markets tend to stabilize and fully recover within a year or so. Events such as 9/11 and the war in the Ukraine have had longer-lasting consequences over the world order, but even in those cases, markets eventually recovered within a few years. Thus, while geopolitical events are important for many reasons, it's critical for investors not to overreact with their portfolios. Second, investors have also been concerned in recent weeks due to stubborn inflation data. The latest CPI numbers, for instance, show that headline inflation worsened on a year-over-year basis, while core inflation has barely budged. One reason for this is worse than expected shelter inflation, which is a measure of rents and housing payments. The deceleration in housing costs that many economists hope for has not fully materialized in the data just yet. This has led the market to expect fewer rate cuts this year. At the same time, market-based expectations have swung 180 degrees since the start of the year, when many believed that the Fed would have to rapidly cut rates if a recession were to occur. Instead, the economy has remained strong, leading investors to rethink their forecasts. All along, the Fed's forecasts have shown that 3 cuts are possible this year. Regardless of exact timing and number, this still represents a reversal from the rapid rate hikes that occurred from 2022 to mid-2023. Investors should continue to focus on the bigger picture rather than the specific timing and size of cuts. Finally, it's important to keep the recent market pullback in perspective. In general, the market experiences several major pullbacks each year, as shown by the red dots on this chart. And yet, history shows that markets tend to recover and end on a positive note, as shown by the blue bars. This is why investing with a long time horizon is so important in order to benefit from recoveries and bull market expansions. In addition, the 2.5% pullback in the first 2 weeks of April are in the context of strong market returns over the past year. For example, the S&P 500 gained over 10% in the first quarter and is up 50% since the bottom in 2022. We've only scratched the surface on these important topics, but we hope that you found these insights helpful. If you would like to discuss any of these topics in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.